Welcome everybody. This is George Veter Financial, giving everybody an update on both the state of the market, and we've had so many people calling in to check on how we're doing with the fires, because that's been very visible. We've had clients from all over the United States continuing to call, so I'll give you an update on that as well. But first of all, we have experienced the first really volatile pattern of the summer in the market. In fact, last week up until yesterday, we had volatility increasing every day, and we had 3 very significant sell-off days in the stock market, especially focused on NASDAQ stocks, technology, biotech stocks, but in general, we've been in sell-off mode. So if that is unsettling to any of you, I want to make sure you understand my feelings on that and why that's very important and positive and constructive for the market to have these periods. First of all, technology has been leading. All of you that have been into reviews all year essentially, technology in this particular market pattern has been leading and has been making up for losses in other stock sleeve areas. The reason why technology has done so well this time is because technology is looked to as answering the questions how we can be maximally effective and productive working from a remote location and or working from home. And so Apple hit an all-time high, as many of you know, Google, of course Netflix, of course Amazon, but all of the leading technology companies, including Microsoft and some of the older established, what we would consider blue chip technology companies, they've all had a phenomenal year and led the market to higher gains. So the more emphasis we've had in our portfolio there, the better our portfolio has done. Now, the concern is when investors are completely focused on just one sector of the economy or sleeve of the economy, like we have been with technology, that valuations get stretched and at some point become unreasonable, and we create a bubble. And that's unhealthy for the market because bubbles always ultimately burst, and that's not what we want. What I like seeing is a rotation of asset styles, a rotation of sector preference. So in other words, technology will be the favored actual part of the investing emphasis for a period of time. If that continues on too long, then valuations get stretched too far, and then we have to implode that sector of the market through popping that bubble. Intelligent investing is what we're seeing now, where investors back off of technology, book some profits, and then search elsewhere in the market for value. So some of the areas that have been neglected or beat up, that's where all the action was during the 3 intense days of selling in technology. Even the airline stocks went up. The hotel casino stocks went up. The automakers, you saw Tesla go down and Ford and General Motors go up. So what that tells you is that's a value play that investors are making right now, which is a very important and great thing to happen to the market. That means investors are making smart decisions and aren't buying into just the momentum side of the investing world. So I like the volatility. I obviously don't want it to get out of hand, but what's happening now where we're trading one preferred sector for another preferred sector, that's healthy investing. And that just tells me that the market can continue to go higher as we are smart about it and as we sector rotate. Okay, so that's the general scenario there. We're also moving into the time of year where we expect more volatility. Historically, since 1950, September, using the S&P as a talking point, the S&P has the worst average return in September versus any of the other 12 months. And then August has the second worst average return. Since 1950, those are the only 2 months that have a negative average return. So it's expected also seasonally that we'd have some volatility now. Now, in my mind, that is like the perfect scenario because we're going to move into the 4th quarter in October, and the 4th quarter historically is our best quarter. October is typically slightly positive. And then we have November, that is a very solid, it's the second best month of the year on average since 1950, according to the S&P data, or group of data, that's what I'm trying to say. And then we have December, which is our very best month historically, has the highest average rate of return. A lot of that because of all of the sales and activity due to the holiday spending, which starts in November and extends through December, through Christmas. Many people call that the Santa Claus rally. And then we always do very well in January on average. Obviously every year is different, but January we call the January effect phenomena. And that is, it's a new tax year starting in January. So people that have contributed all they can during the year, because there's contribution limits to defined contribution plans like the 401ks, highly compensated people cap out on their distributions that they can make sometime during the tax year. But in January, everybody is free to make contributions because it's a brand new tax year. So people that were capped out, whatever, in August, September, October, they'd contributed all they could. Now all of a sudden they can start contributing again. So we have this massive influx on a normal year of new contributions into the market in January because contribution limits now are all open for business with the new tax year starting. So that rolling quarter, which usually starts halfway through October when earnings start for the third quarter, then we have November, December, and January is the best rolling quarter. I just mentioned that, not only that you can look forward to that, plus we'll have the uncertainty of the election over in early November. That's all of those things are super bullish for the market. And if you were we've been taking cash for investors through the summer, and we've been layering it in the market through dollar cost averaging. We talked about that earlier, anticipating some of this volatility and actually getting better pricing for the parts of our portfolio that we're accumulating because of the volatility that now we're getting, that we anticipated getting. And then we're completely saddled up with our investment portfolio sometime in early November, or at least by the middle of October, that time period. That way we can enjoy fully invested what historically has been our best bullish pattern in that time of the year. So volatility's okay. It actually sets us up. If we have some weakness in September, it sets us up for a more attractive market to move into the best period of time on the calendar for stock gains. So bottom line, don't worry about the volatility. If it does concern you, please call me and we'll have that individual chat. Obviously, I'm telling this story based on my history in this business and my study of economic and political history as you come in for your reviews. But if you're not due for your review in the next couple months, you're welcome just to call me and talk about what's going on and where things are being bought and where things are being sold, etc. And I love having those conversations. So that's what was on my mind economically. As far as all of my wonderful clients that have been concerned about the fire danger in California, knowing that we're kind of in the middle of it, there's Karen and myself and Carrie and Brian that live in the Foothill region. And so all of us are, there's evacuation orders all over the place in those communities where we live. The one fire that they call the Creek Fire and then the Peckinpah Fire have merged to like a massive monster fire that has been moving in our direction. Still about 20 miles out from where we actually live, but with wind speeds, they can change, and overnight it can be at our front door. First of all, right now, nobody's lost any property in this, and we all feel blessed that we have been able to be away from the maximum amount of damage. And we just feel all kinds of empathy and love for those people that have lost homes and have been in the middle of this. So those are the two feelings. And we feel grateful for our success in being able to avert it so far. Now, I have a 3,000 acre cattle ranch. Most everybody here knows that. So I have a lot of border that could be invaded by this fire. I want to tell you that I feel complete peace. I've spent 15 years brushing this ranch. So I have this massive fire break. Yeah, the fire can get to me, but we can easily stop it if it were to get to me, because we have all of this cleared country with just scattered trees now and no brush, and we can just punch fire lines in. And my mother's home on the other side of the ranch, Joe's home over there, my sister Tammy's home, we completely have that protected at this point. My house has got a huge perimeter of brushed property, so I'm in a very defensible position. So if the worst case scenario happens and one of these firestorms blows into the ranch, we are ready, and we've been preparing for years for this, and we'll be able to stop it in its tracks and keep our community safe. So all I feel is peace and gratitude, and I appreciate everybody's concern, but we're in a really good position for this moment in time in this kind of scary environment. So my attention is still here. I'm focusing on maximizing portfolios, focusing on serving clients, focusing on building the relationships that are so important to me with the people that trust me to help them successfully guide into and through their retirement. So God bless you. Thank you for enduring another one of these chats from me. Hope you have an awesome week. Again, grateful for all of your loyalty to our team and our practice. And until we talk next, keep safe, and blessings to you. Thanks.